We are live. Welcome, everybody. Hope you're having an enjoyable weekend. Hope you had a great weekend. We're starting a brand new week tomorrow. My name is Matt Terrio. I am CEO of Epic Real Estate. And this is where we show people how to invest in real estate, placing a huge emphasis on escaping the daily grind and retiring early. So that's what we do here. And a big part of that, or being able to make that happen, is knowing what's going on with the real estate market. There's a lot of uncertainty right now, a lot of wondering what's going to happen. And I would love to be able to give you a definitive prediction with absolute certainty. But nobody knows, right? And anyone that says that they know, they're just pretending. But all we can really do is just look at the data and then make the best decisions that we possibly can based off of that. So I wanted to share that with you today. If I switch over here to there, and then if I come over to this, and I'm a little bit late, so forgive me, but I literally was just putting this together at the last minute, trying to pull the most up-to-date data that's available right now. So if you like what you see, I would love it if you hit the subscribe button and hit the like button and show your appreciation. That lets me know that I'm giving you what you want to hear. And if you got any comments or questions or criticisms, I love it all. There's the little chat box right there. And so feel free to participate that way. So I'm going to kind of just show you what I found, and then I will go ahead and I'm a one-man operation, so I can't really see what you're typing in while I'm going through this information right now. But after it's all done, I'll go back and I'll review that, and then we can engage and have a conversation. It'll be fantastic. All right. So cool. The market, where is it going? Don't we all want to know, right? Let's see. I'll start here with a famous quote from one of my favorite groups, House of Pain. Word to your moms, I came to drop bombs. And what I mean by that is there might be some information that you have already, and you have already shown up with some sort of preconceived notion of how the real estate market is and where it's going or what the economy is looking like. Unfortunately, politics plays a big portion into this, but let's try and leave our emotions out of this and just look at the facts. And I think a lot of the facts that are available right now, if you just did a little bit of research, you'll find that, wow, I didn't know that, because how would you? Because that's not what everyone's talking about, okay? So first thing, the benefits of investing in real estate. Why is this even important? Why would you even want to know? So I came up with a few things here. Number one, cash flow. It creates residual income, the type of income that will come to you on a monthly basis without a whole lot of direct participation on your part. Certainly it's not, I wouldn't call it totally passive income, but it's the type of income that you can generate to where you might not have to work or might not have to work as hard. And certainly give you the options of freedom. So that's number one. Number two, appreciation, right? We all know real estate continues to appreciate. We're going to talk about that a little bit right now. And so, but is it going to continue? That's what we really want to know. We know it has historically, but does it necessarily equal the future? Third thing, tax deductions. And this is one like the real final tax havens, the tax shelters for the average person. And as new bills and new laws and new policies are being implemented and are discussed and voted on, tax deductions can be a really big deal. And it can really eat into your actual income, the money you get up each and every day and go to work so hard for. So, you worked for it, you deserve it. We all pay our fair share. But we don't want to pay more than that, right? We want to keep as much as we possibly can because we worked for it. So tax deductions, real estate is really important for that. Next is amortization, which I think is one of the more underrated, under-discussed benefits of real estate. Because if number one there, cash flow, that's going to create an income that's going to allow us to live and pay our bills and create that type of financial freedom for us. That's really important. But the amortization, the paying down of the debt, that's really where the wealth is being built. So we have the income to provide for our daily living, but we have the amortization, the paying down of the debt to provide for our future. And if you do it enough times and you do it right, that can be a legacy for your family. And if it's income property, if it's investment property, this is what's the great thing between the big distinction between, say, your primary residence and an income property is that with your primary residence, that's you paying it down, right? You're paying for that property. You're paying for your home. With an income property, it's your tenant that's paying it down for you. So someone else is buying it for you. So the amortization, I think, is really underrated. And I think it's one of the more important aspects of this, because we all want to be rich, of course. We want to be financially free, but the real wealth, it gets created through the amortization. Next is it's real. It's probably why they called it real estate. It's tangible. It'll never be worth zero. And I think that's an also underestimated or under-discussed aspect of real estate. And it's one of the essential needs of humanity, right? We all need a roof over our head. We all need shelter. We need protection from the elements. That is never going to change. So it's real. It'll never be worth zero. It'll always have value. It may go up and down in value, but it'll never hit zero. Companies on the stock market, they go out of business all the time, right? And that if you invested in one of those and they go out of business, boom, your investment's worth zero, okay? And then the last one I came up with is, which I think is really important, leverage. And that's a good word to some people. It's a scary word to others. And it's a bad word to others. But what leverage does is it allows you to not just use other people's money to acquire real estate and all of these benefits, but it allows you to really maximize your return, to be able to get a bigger and better return than you could with exchanging your time for dollars, or even putting your money in the stock market and depending on the eighth wonder of the world of compound interest. Leverage can really get you moving fast. And if you use it correctly, it's probably the most powerful wealth building tool that we all have available to us, at least the average folk like us, right? So this is why this is important. These are the benefits of investing in real estate. And if you don't have any, you're going to want to get some. Because if you look at the stats, you look at the data, I won't go over all of that because I want to get to the housing market conditions and everything. But you really just don't stand a chance of any sort of financial freedom unless you incorporate real estate somewhere into that plan, right? So if you don't have some, it's time to start thinking about getting some. Andrew Carnegie, one of the richest men that ever lived, perhaps the richest if you adjusted his net worth for inflation. But he's got a few very big quotes here. And people come to my channel and they go, why should I listen to you? You're not wealthy. It's like, you don't know what you're talking about. You're not a real investor. I hear that all the time. And yes, I am, but I'm not trying to prove it to anybody. But, you should listen to people that have more than you. And maybe you do have more than me, right? I wouldn't call myself disgustingly wealthy by any means, but I do okay for myself. And I've done okay over the last decade. But I listen to people that have more than me, and that's who you should probably pay attention to as well. If you want what someone else has, there's some good clues, some good hints, as if you do what they do in the manner that they did it, you got a good chance of getting the same results. And so Andrew Carnegie, 90% of all millionaires became so through owning real estate. 90%. I don't know if there's an actual study, but I tend to believe someone that's built millions and millions of dollars of net worth. More money has been made in real estate than in all industrial investments combined. And then the wise young man or wage earner of today invests his money in real estate. Quotes from the richest man that's probably ever walked the planet. And then this is more recent. So that was back then. This is now. And this came from Keeping Current Matters. There's an author out there, and I could not find his name. I was trying to rush here to get to you, and I wanted to get all these slides ready and you have them look as the best they possibly could. But there's an author out there. I heard him interviewed on Jason Hartman's podcast, and he's probably done the most exhaustive study of home ownership and how it impacts the wealth of the individual. And his result was the homeowner has 40 times greater net worth than renters. And that could be just your primary residence, and that's a fact. All right, so if you want to be wealthy, then you're going to want some real estate. Okay, that's all I'm saying. Now, got a lot to cover, and if you want some more help by the time they're done, I'll show you how to get it. Otherwise, this is just an informative, educational presentation, I guess. I'm not even really presenting anything. I'm just sharing with you what I found, and then I'll share with you some of my predictions and what I am doing based on this data, and then you can collect the data, get informed yourself, and make your own decisions and decide what you want to do. Because if you are totally happy with where you are financially, don't listen to me, right? I'm not trying to interrupt your flow. I'm not trying to interrupt your happiness and what's working for you. If something's working for you, stick with it. I'll just show you what's working for me, okay? And by the way, we are getting together next week or it's this week for I'm getting together with a small group of investors for a little workshop, a virtual workshop. Don't have to do any travel or anything like that. We're going to spend the whole day next Saturday. And we're going to go over creative financing strategies, how you can use more of your mind to acquire real estate and a lot less of your money. So if you'd like to join us, you can go check it out over at creativefinancingmasterclass.com. All right, so let's go ahead and look. Where's the market going? That's the big question, right? Is it a good time to even be in real estate? So let's look at that. You have to understand, though, before you make that decision, is that the market does go in cycles. Okay, so we've got 4 phases of the real estate market cycle. Here's the 4 quadrants. We start phase 1, which was called recovery. That could have been like where we were in 2009-ish, 10-ish, 11, right? We just came out of this big giant crash and now we're recovering. There's no new construction going on. There's all types of homes on the market. Everything's available. You're probably getting really good deals. But as those start to get consumed and the demand catches up with all that extra supply, we move into phase 2, expansion, where we have long-term occupancy and the vacancies are declining. New home builders are starting to think about building new homes again because they're seeing that people are buying again. And we kind of hit this peak right there, where the demand and the supply equate to each other. And that's where new construction really will kind of kick in. And then we move into phase 3, where all of those homes start coming on the market and the demand starts to diminish because the supply has caught up with the demand. We start seeing a lot more vacancies, and then we start really completing all of those construction projects and move into phase 4, which is we call a recession. So this is typically a 7, 8, 9 year cycle, right? And I don't know, as you look at those, which one do you think we're actually in right now? Do you think we're in phase 1? Do you think we're in phase 2? Do you think we're in phase 3? Do you think we're in phase 4? I don't know. It feels like we're really still heavily in phase 2. And what's kind of remarkable about what we're going through is if this is typically a 7, 8, 9, 10 year cycle, we're really overdue for this thing to correct. But it's just not showing any signs, as you'll see, that it wants to correct, that it has any intention of correcting. But those are the normal cycles, and we're way overdue. And I think a lot of people are thinking we are going to crash just because we are overdue. Because it happened in 2008, it must happen again. That's a lot of people think that way. And I see you guys in the comments all the time here on the YouTube channel. So I know that, but then there's no data to back it up. Like that might be your emotion, that might be your opinion, and you very well may be correct. But why? Right? Not just because it happened is going to happen again. Okay. So just things to think about as we're moving forward. There's also the cycle of market emotions. And I won't spend too much time on this, but as we go through those 4 cycles of the real estate market, we're experiencing this as a society with regard to not just real estate, but the overall economy. We start over the left as things start to go good and we start to feel optimistic and life is good and we're excited and we're thrilled and we kind of hit this peak and like, oh my gosh, what can I buy next? And total euphoria. And then we hit this little peak, and that's the point of maximum financial risk. But that's when the market activity is so robust and it's so active. And people are getting in, and you're hearing it from your bartender, and you're hearing it from your hairdresser, and everyone wants to be in the real estate. Everyone's excited. But that is the point of maximum risk, and that could be kind of an indicator as to maybe the market is about to shift when everybody that that's not typically in real estate really is excited. And then, things may slow down a little bit, and a little bit of anxiety may kick in because you've made these investments and now maybe it's not turning into what you thought it was or not turning into what you thought it was fast enough. But then you go into denial. It's just a temporary setback. It'll turn around. And then it doesn't. And then you kind of get a little scared and you get a little desperate and you panic and now you're totally hopeless. And we hit this bottom point. Now this is the point of maximum financial opportunity. But this is when nobody wants any piece of it. They don't want any part of it. And they're like, don't talk to me about real estate. And a lot of people felt like this. And a lot of people still feel like this. A lot of people got really hurt in the 2008, 2009 crash and lost a lot of stuff. And those wounds are fresh. And they're a little bit depressed. But then the market starts to pick up. And hey, maybe there's hope. The worst, it might be over. A little bit of relief. And then you're optimistic all over again. And we start this whole cycle all over again. So I don't know, based on what you're feeling right now and the people that you're talking to right now, what are the emotions out there? I know we just came out of the pandemic and everybody was getting a little excited and a little optimistic, right? And we're getting out there and we're starting to get back to business and back to life as usual. And then, the variant came along and kind of, kicked us in the shins for a second. And we're kind of wondering, okay, is this going to be as long or is this going to be short-lived? And so there's a little anxiety there, maybe a little bit of fear. I know a lot of people are sitting there in denial. No, this is nothing. And we just need to keep on going. Or maybe people are just depressed about it and wondering if life is ever going to return back to normal. Those thoughts have actually crossed my mind a couple of times. Like, I don't know if we're ever going back to normal. But anyway, these are the normal cycles, okay? Or the normal emotions that we feel during the cycles. So here, this is the Case-Shiller Housing Home Price Index for the nation. And so it's probably no surprise. This is what the market has done. And you go all the way to the far right. This is where in 2021, we were at an all-time high as far as home values. You can see that big giant lump there in the middle. And then it came crashing down. That was 2007, 2008, 2009. And, but the cycle, that 7 to 8 year cycle, like it's really pronounced right there. But it's happening in a little bit of increments all along the way, these little ups and downs, ups and downs, ups and downs. But it's just so pronounced right there because that was such a big deal. And everyone's expecting that again. But understand that was once in a generation, maybe for sure once in a lifetime experience. Nothing like that had happened since like in the 1920s, 1930s. So that was 70, 80 years separation from a massive economic crash like this. So to predict that one's going to happen, 10 years later, 20 years later, statistically, then the statistics aren't on your side, right? So we have to look at some other stuff. So just because it happened once doesn't mean it's going to happen again. Next. So why is this happening? Why are the prices going so up or going so high? Well, it's really just supply and demand. Okay. And it's always supply and demand, but there's things that run the supply and there's things that run the demand. But I think right now, authentically, the supply and demand is really sound and solid. And when the supply and demand is solid, when the demand is genuine for a scarce asset, then it doesn't really mean there's a bubble, right? That kind of is the opposite of a bubble. And it might get bigger and bigger, and there may be a bubble down the road. But if it's a genuine demand and there's limited supply of something that people actually need, like I'm not talking about Pokemon cards. I'm not talking about the tulip craze. I'm talking about housing, something that people actually need. There might not be a bubble right now. And it's just supply and demand. We'll go through this, but we can see that dark blue line as it slowly moves down. That's the housing supply. Like it's getting lower and lower and lower. It says with inventories at record lows, existing home prices continue to head up. So when your demand is really, really high like it is now, and we'll see why it is, and then you see the supply diminishing, the prices can only go one way. Okay? And I don't know if that dynamic is going to change anytime soon. If we have a bubble and it pops, that happens because of weak economics. In 2008, we had very weak economics. We don't have those right now. Okay, that the same conditions that happened in 2008 don't consist right now, or don't exist. Excuse me. This is I think this is from Forbes, and I put some of these up here. I didn't put the whole article, but this is from Forbes, and you can go and research and read these whole articles. But the housing shortage is worse than ever, and will take a decade of record construction to fix. New reports say. That new report actually came from the National Association of Realtors. So they're saying we might be in this inflating market for the next 10 years until the supply catches up with the demand. So here's the supply, how it looks. These are the U.S. housing starts since 2006. So you can see right there in 2006, it came plummeting down. No builder stopped building because people stopped buying. I don't have the chart. I put it together too quickly. But as we see from 2009 inching up to where we are in 2021, that is growing really, really slowly. And this is kind of to my point, what I was making earlier, that there's a lot of fresh wounds. People remember how painful that was. New builders just got their legs cut out right from under them, and they lost everything. And so as we've moved over the last 15 years or so, let's see, 9 to 21, I guess that'd be 12 years. People have been really cautious. The new home builders are like, I ain't doing that again. So they're building really slowly. And that's very much contributing to what we're dealing with right now. Not to mention that the existing houses on the market are all-time lows as well. So this is what's going on. They're taking their time. Now you can see a big giant dip there on the far right. That was right when we went into the pandemic. And then a big spike bounced right back up. We got that V-shaped recovery, so to speak. And new home builders are at it again. They recognize the demand. But you can see like it's not just skyrocketing up, right? We've had a little bit of a dip here recently, and it's dropping. And the reason being is, and I don't have a graph or a chart for this, but it's common knowledge. The price of lumber has skyrocketed. Building materials have skyrocketed. And not only are the prices more expensive, they're scarce. They can't find them. Just appliances and the sand that they use to build the concrete. And then there was like the flat steel that they build the molds for the foundation. These types of things that are essential to building houses just aren't available in the quantities that we need to keep up and build the type of housing that we need to build to keep up with the demand that's out there. So speaking of demand, so that was supply. Now let's look at the demand. Because you might read the news, you might hear it on the radio. In fact, I just heard it recently. I listened to Sirius Radio, a bunch of different news stations there, and they were talking about how our population is slowing in growth, and we're producing less and less and fewer people. And so and that could be true, but if you look at what's actually happening, there's something that the media will do, and a lot of people do this. They'll focus on the statistic, like what's actual. But they will kind of ignore what's factual. So if you look at this orange line going through here, this is the percentage of our population growth, how much it grows year over year. And so if you look back in the 1800s, I mean, our population was growing at 30% a year pretty steadily. And then as we moved into the 1900s, we dropped down into the 20s and then the teens. And, in the 60s, we started to pick up a little bit. And we're at 19%. And so you look at 19% there, say in 1960, kind of around the time, I guess, right at the tail end of when the baby boomers were being born. That's 19% of the population being 155 million people. So 19% of 155 million people, that's your number, right? And then if you go into the 2020, like we've dropped all the way to 18%. We've had our percentage of growth more than be cut in half. But that's 8% of 350 million people. So that blue line represents actually the quantity of the people that are walking the earth. So although our percentage of growth is dropping, the number of people walking the earth is getting bigger and bigger and bigger. And even with these predictions of 2030, 40, 50, 60, that we're going to continue to drop in our percentage of growth of the population. That blue area, that's not dropping. We're adding more and more people. That's what I meant, that we have authentic, genuine demand. We have people walking the earth right now to fuel the need for more housing well into the next few decades. Certainly for as long as we're going to be here. Okay, so that's something to look at, the demand. And don't let the media lie to you and say that the population is shrinking each year, because it's not. The percentage of growth might be declining, but the number of people walking the earth continues to increase. And so here's something that's really key. We're talking about the millennials. And this little spot right here, the age group from 20 to 29, this is where the bulk of our population is right now. And between the age of 20 to 29, the average home buyer is 31 years old. The average first-time home buyer is 31 years old. And the peak is at 29. The peak of our population is 29. So there's another part of it. Not just we have a lot of people, we have a lot of people in a very finite decade that need to buy their first house. So the demand, it's here, it's authentic, and you can look at it this way as well. I don't know if you can see my mouse, if that will show up. I don't know if you can see the little cursor, but I'm right over the millennials, right at the peak, right at the highest part of this little yellow spot. That right there, that is the 29-year-old spot. And you just go 1-2 bars over, that's where we're 31. So over the next 2 years, we're going to have the highest demand we've ever seen for first-time houses. And that's not going to stop. You look at Gen Z, over here, which we don't talk about too often, I guess because the millennials kind of dominate the population at the moment. Gen Z is a lot younger, but you can see Gen Z is a bigger portion of the population than the millennials. And they're significantly bigger than the baby boomers. And the baby boomers is what started all of this. They're the demand that started this need for housing and every other single industry. So that's what I'm saying is like our supply is really damaged. Our new home builders are not building as quickly as they used to. And the demand for that housing is exceptional and it's not going anywhere. And that could only do one thing for housing prices, and that's causing housing prices to go up. When the demand is that strong over the supply, it can only go one direction. Yeah, but Matt, people can't afford this forever, right? No, you're right. They can't afford this forever, and I get that. But there was more wealth created in 2020. The average net worth of the average house grew by 15%. Their average debt dropped by 25, 30%. So people have got money and their debt is shrinking, and they are overpaying for houses right now, as you know, if you've been out in the housing market, and they are overpaying because they can't afford it. They got this. They're good. There's enough people out there to keep this going for a little while. I agree. It won't go forever. But when it stalls or when it stops or when it pauses, because of the demand that you're looking at here right now, probably not going to be a crash. Could be an adjustment, could be a pullback a little bit, could be a flattening. We could hit a plateau, but probably not a crash. There's just too many people that need houses. So let's look at what's driving this also. These are interest rates. Historically speaking, this starts back in 1975. Interest rates were like 9%. They skyrocketed in the 80s. Can you believe people were paying 19% interest on their houses in the 80s? And they were paying 19% for their houses in the 80s, and prices were still going up. But over the years, over the last several decades, we can see what's happening. They continue to decline and drop and drop and drop. And we are at our all-time lows, give or take a half a point or so. So this is another big part that's fueling this demand. It's a lot easier to buy houses right now because based on the monthly payment, it's affordable, not a big deal. People might be overpaying for their house, but on their monthly basis, they're not stretching themselves right now because of the interest rates being so low. But that is the big variable. The supply and the demand, that's fixed. And that points to only prices going in one direction. But the interest rates are the big variable. So whatever happens with those is really going to dictate which way the prices go. The Fed lately has said they're just going to keep the easy monetary policies right now for a while. We don't see any big increases anytime soon. But I got this off of, I think this was Wall Street Journal. I did not get a note of that. But mortgage interest rate predictions and forecast. Mortgage rates likely to rise from current levels by the end of 2021. And we can see what those rates are over there, right? We got the 30-year fix is 3.2%. We come back over here. That's pretty much on our all-time low, right? And 15-year fix, you can get a 2.6% interest rate. The FHA 30-year is 3.5%. VA loans are 2.9%. Jumbo is 30-year fixed at 3.19%. Okay, so that's where we're at. You can buy a lot of house based on your monthly payment with those interest rates. So I went through a few different predictions because this is not my expertise when it comes to interest rate. I'm not an expert on the monetary policy. I keep educating myself because I understand how important it is and I want to be, but I would not consider myself an expert. I might know more than most people, but I'm not an expert. This is Len Kiefer, Deputy Chief Economist with Freddie Mac, anticipates the currently low mortgage rates to continue throughout next year. Our forecast is that rates will be relatively flat next year. So we're looking at, based on him, he's saying we're going to be good for a couple years. Here is Greg McBride, Chief Financial Analyst for Bankrate. He sees rates fluctuating between 0.5% and 0.75% early on in 2021. That's not the mortgage rates. That's the actual, the Fed rates. But next year is likely to see a fair amount of volatility, and we'll see a lot of the record low rates that we've seen this year. So he thinks it might go up and down, but we might hit some new lows. Danielle Hale, Chief Economist at Realtor.com. She sees the low rates continuing through the first half of 2021. Making any kind of prediction for next year is difficult, but our expectation is that mortgage rates start the year roughly in line with where they are now, and they stay fairly low, right around 3%. she's not seeing a whole lot of change either. Then Logan Motashami, housing data analyst of Housing Wire. Based on how low interest rates were in 2020, he believes that we'll see the average mortgage rate continue to inch upward in 2021, but it is difficult to see it going above 4% since we're still in the thick of the COVID-19 pandemic, right? That hasn't gone away yet. It's dissipated a little bit, but we're still dealing with it. Then Lawrence Yoon, chief economist with the National Association of Realtors, believes that remortgage rates will remain stable in 2021 with the potential for a slight increase from the all-time low of 2.65% we saw in early 2021 for a 30-year fixed. So again, interest rates are going to be pretty stable. So for a couple years, maybe not a whole lot is going to happen. Now the Fed can come out and change all of that right away. But that's what we're looking at. And those were 5 experts from 5 different organizations. And those were their opinions. Now, mortgage rate forecast over the next 90 days. So here we are, April 31st. Let's see, July, right there in August. So that's pretty much flat. That's from Freddie Mac. So over the next 90 days, we'll see a little bit of an inch up there, but not enough to have any sort of impact on housing prices. So no crash coming in the next 90 days for sure, based on those economists that we just talked to. I just showed you those 5. Probably not over the next couple years. Okay? Housing market going to be strong. That's why I'm saying it's the supply and the demand is authentic, but the money supply is the big variable, or the money policy is the big variable, and that could impact it one way or the other. But let's look at what's going on also, because we got all these people in mortgage forbearance. They're about to lose their house, is what a lot of people think. We got a lot of people dealing with rents and about to get evicted, and that's going to cause a big crisis. But let's look at this real data. So this from the National Association of Realtors. 77% of homeowners in the forbearance program have exited it. They've left with a loss mitigation repayment plan in place. So 77% of the people that were in the forbearance program have left that program, and they did not lose their home to foreclosure. 77%. That's like more than half, right? So almost all of them. But there are 23% left. Let's look at them. Of all the people that left, 27.6% had a loan deferral or a partial claim. 24% borrowers continued to make their monthly payments during their forbearance period. So even though they were in the program, a quarter of them were just still making the payments anyway. Then we're going to come back to this 15.3%. These are borrowers who did not make all of their monthly payments and exited the forbearance program without a loss mitigation plan in place yet. So this is 15.3% that potentially are still delinquent and behind on their mortgage payments. We'll talk about them in a sec. But then 13.8% reinstatements in which past due amounts are paid back when exiting forbearance. So they came clean, they paid their money back and they got current. Then 10% loan modification or trial loan modification. And then 7.5% loans were paid off through either a refinance or by selling their home. So those don't exist. And then 1.5% repayment plans, short sales, deed and lieu, or other reasons. So those are just kind of your 1.5% of your variables. But let's talk about this 15.3%, because these are the people that they've left the mortgage program and they don't have a plan in place to how to recover, how to repay. So that 15.3% represents 400,000 homeowners who exited the forbearance program. So there's 3 possible scenarios. Some could list the house for sale. Could be 1/3 do it, 2/3 do it, but let's just say none of them. Then they all lost their home to foreclosure and they all went on the market. So all 400,000 homes went on the market. That only represents 25 additional days of supply of inventory. That's it. So that's not going to impact the market one way or the other. It might for a month or so. There might be some extra opportunity, but those are going to be consumed so quickly based on the demand that it's not even going to impact the market. So the forbearance program and the expiration of that, whenever it does, as our leaders in power continue to kick that can down the road, but it will eventually, but it's probably not going to have an impact. And the reason it's not going to have an impact, one is the demand as I had recommended, but also we saw what the home values did. These people all have, even if they are behind on their payments, they all have equity. They're not just going to sit at home and wait for the bank to come take it from them. No, they'll just put it on the market, they'll sell it. They'll go ahead and pay a portion of their profits to the bank to come clean on what they owe. And they'll put the money in their pocket and they'll leave with a profit. probably not going to foreclosure. All right. Next, the eviction moratorium. So this is a common headline. As the moratorium ends, millions of Americans face eviction. This was just at the beginning of the month. So you would think, oh my gosh, all of these people are going to be homeless, right? All of these people are going to lose their house because millions are facing eviction. Let's look at what that really means. And it's a true statement for sure. I'm not going to play that down at all. And I'm not, it's not that I don't have empathy for these people, but just want to look at the data. I want to look at the numbers. And so this came from Eviction Lab. So this is evictions and eviction filings. So this is back from 2016, my bad. So the red line are the actual evictions. The blue line are eviction filings. We can see in 2016, 3 years, 4 years before we even heard of COVID, under normal conditions, there's always millions of people facing eviction. This is like almost 2.5 million people facing evictions. So yes, this is a problem. I feel bad for these people. I don't want them to be kicked out on the street. But whatever we're dealing with right now, as far as evictions go, it's not a pandemic problem. This happened 3 years, 4 years. This was going on like this 3 or 4 years before we even heard of the pandemic. So it's not an a pandemic problem. What do I have next here? Yeah, but no one's paying their rent, Matt. Why would you get an investment property? No one's paying their rent. Well, let's look at this. This is the rent payment tracker. Let's go down to June, because this is the most recent one, down June. So in 2019, at the very bottom, that third line from the bottom, that little section, June at the bottom, 2019, 96%, this is before the pandemic, 96% of people paid their rent by the end of the month. That orange part represents they paid it on time. That little blue extension there means they came in late, but they did finally pay. 96% in 2019. 2020, amid the pandemic, look at the numbers. We're at 95.9%. It's only a 0.1% difference. Then we look at 2021, a 0.3% difference. And if you do that now, go through May, go look at April, look at March, look at February, we're pretty much 95% of the people make the payments on their mortgage, on their rent, all the time. Pre-pandemic, amid the pandemic, and post-pandemic. So the numbers haven't changed at all. Now, granted, there's 5% out there that are struggling and not unable to make it, and maybe some of them very well are unable to make their payments because of COVID. But overall, the rental market, it is not experiencing any sort of rental crisis due to the pandemic. I'm not going to negate and ignore the exceptions out there. You may know somebody, it may very well be yourself, someone close to home. They lost their job because of the pandemic, but the overall numbers, completely unaffected. It's not a pandemic problem. So my point being is that we're not going to have a bunch of landlords with vacant houses and people that aren't paying their rent. We're not going to have a bunch of people hit the foreclosure market and selling their houses and losing it to default and all these discounts. So I've got some, I think predictions is next, right? Yep. So here are my predictions moving forward. One, assets, the asset values will continue to rise. Housing prices, I think, are going to go up for the next, for definitely for the rest of this year. I would put money on that. Buying property still, I'm not stopping. And I think that's going to go well into 2022 also. I think with primaries, not primaries, but the midterm elections coming up, I don't think the current administration will do anything to cause a housing crash. It would be, I think the polling has them already a little bit behind in the approval ratings. That would only make things worse for them. I think they're going to maintain the steady course of the monetary policy well through 2022. And so I think asset values will continue to rise. I think rents will rise. I didn't put this this chart in there, but there is a chart. I was just running late, and that's why I didn't get it to you, so I'm sorry. But there is a chart, and you could take my word for it, or you can look it up yourself, because it would take one Google search, and you'll see it. That says the demand for apartments is at an all-time high. It's not an all-time high. It's at a decade high. It's a 10-year high. And that's because we have all of those people in those demographics. They need a place to live, right? Number three, interest rates. I think they're going to rise, but very, very slowly. But it is the big variable. That is something that could kill every single prediction that I've got here for you. But I don't see the Fed and I don't see the current administration doing that, because it wouldn't be just devastating to the housing market. It would probably be devastating to the entire economy. The stock market for sure would come crashing down as well. So I think they will rise, but very, very slowly. It'll be negligible. Number four, I think the housing industry will flourish. How could it not? You know, a home builder goes out and builds a house, and there'll probably be 10 people waiting on the doorstep, waiting for him to put the final nail in so they can buy it. That's how strong the demand is. And I think that goes for existing homes as well. I think it's a great time to be a real estate investor. It's a great time to get deals under contract, because the person with the deal in this market is really calling the shots. And you've got all the power because you've got people lined up that want it. So I think the housing industry is going to do very, very well for a while. And number five, I think the rich and the poor gap, the gap between the rich and the poor, will continue to widen. And so I think you get to make a decision on which part of that gap you get to be on, right? Which side of that chasm you want to be on. And as I showed you right from the beginning, just by owning a single house can almost single-handedly make sure you end up on the right side of that gap. As homeowners, property owners are 40 times wealthier than renters. So if you don't have a house, I would recommend getting one, multiples if you can. And you're like, well, it's too expensive, I can't afford it, Just start with your FHA loan. And I'm not a lender, so I'm not getting any business from this. I'm just telling you what I would do if I were in your shoes, and I'm actually telling you what I am doing at the moment. I'm buying as much as I possibly can still. But 3.5% is all it takes to get into a house. Just get it. Live there. It doesn't have to be a mansion. You probably won't be there very long anyway. And let the market do its thing. I didn't even talk about inflation. That's another huge variable that would be very much on your side, owning real estate with a fixed loan into it. And just get started, get something, get educated, whether it's going to be your primary residence, it's going to be an investment property. Like I said, if you want to join us this week, I'm getting together with a group of investors, showing them creative real estate investing strategies where they don't need a lot of money, where they can use more of their mind than their money. If you'd like to join us, check it out over at creativefinancingmasterclass.com. You can get all the details over there. And if you like what you see, grab yourself a seat. If you don't, that's fine too. Maybe we'll catch each other next time around. But that's my housing market update. Those are my predictions. So let's see what y'all have been saying since I've been here. Let's see. Boink. Now I can see your comments. Hey, Brendan McCaw. Yes, all is well. Good to see you. Harry, how long might the moratorium actually last? It's killing the landlords. Well, that's a good comment, Harry. And a lot of people think that, but I don't know if it actually is killing the landlords. If you probably typed that in right at the beginning, but the stats aren't showing that it actually is. And if you're a landlord and you're having an issue, then I feel for you for sure. I'm not saying nobody is, but overall, it's not killing the landlords. I don't know how long it's going to last. I really don't. I think it's going to depend greatly on us. I think a big indicator will be, when we can take the masks off, right? And I think once the more people are vaccinated and the cases drop, I think that could be a big indicator as to the end is near when it comes to the eviction moratorium. Nimi Bernie, I'm a licensed realtor broker in Atlanta, Georgia, and new home builders are backed up for months. Exactly, right? To my point. Luis Flores, howdy to you. Will there even be a correction in a linear market, or just one as pronounced as a cyclical market? Yeah, there's a lot of exceptions, right? And you type that in at 429. So if you were here at the beginning and kind of stayed through the whole thing, yeah, I think what we've looked at as far as housing cycles go and the housing market cycles go, we are in very different times, and I don't know if we can count on that. I think only history or the future will tell when we can look back on history to see where we really are right now, right? So I wish I had a really good answer for you on that one, but like I said, I don't know what's happening in the future. Let's see. Yep, so true. Rents are costing like $1,800 for a like property, and my mortgage is $1,070. Inflation is going up, but I'm insulated thanks to my property. Yes. The one way to really stay ahead of inflation and have it work on your side is to buy or invest in inflating assets. And if you can use US dollars that are suffering from inflation, if you can use US dollars that you borrow to buy those assets that improve, it's like a double whammy. Because as inflation is eating up the value of your dollar, the purchasing power of your dollar, it's also eating up the debt that you borrowed to purchase that asset. So I'm doing as much of that as I possibly can. Just make sure that that debt that you do take out, that it's fixed debt, because you don't want that to fluctuate with the market, because that kind of defeats the whole purpose of working against inflation. Thanks, Brendan. Thanks for sharing. And by the way, if you like what you're seeing, go ahead and hit the like button there, and that'll signify the YouTube algorithm that we're all talking about good stuff that we wanted to learn about. Lewis, I'm actually thinking of buying a property in McAllen, Texas, and renting my home in Rhode Island. At least that's the plan. Yeah, I think you can't go wrong. I think the more real estate you own right now, as far as all other investment opportunities, I think it's a really, really safe one. You've got the built-in supply for as far as we can see for as long as you and I are walking the planet, for sure. Brendan, everything you're sharing, I'm seeing, encouraging, you're seeing the same things. Good. Thank you for confirming that, because it is what I'm seeing. And I follow a lot of people. I follow Kathy Fettke. She's really smart. She's really up on the stats. If you don't know who she is, she's got a great channel here on YouTube. Doesn't have a lot of followers, which is really sad, because she has really valuable information. So go check her out and subscribe. I listen a lot to Jason Hartman. He's a little bit more outside the box, but I really believe in what he says. And then the guy I forget his name, over at the Rebel Capitalist show, insanely brilliant. And then, I just bought a house yesterday. I'm in the market. I know what I'm seeing. And so I just kind of compare all of that, and that's where these conclusions come from. But good, Brandon. Thanks for confirming that you're seeing the same thing. Alexander, I've been looking for houses in Harrisburg, Pennsylvania. It's so difficult to find a house I actually want to buy. Yeah, and that might be true, Alexander. And I don't doubt that whatsoever. But I would recommend buy something that you can at least deal with for a minute. There's a good chance that you deal with the house for a year or two, particularly if you're going to use an FHA loan, like so many people are doing to get their first house. You might not be able to get your dream home. You're not going to get a palace. You might not be in the ideal neighborhood, but it's just your launching pad. It's your starting point. And you're there for a couple years. You go ahead and you refinance, and then you get to go buy something else. Okay, and buy something that might be more to your liking. But you got to get started. That's my point. Jay, late, will be watching on the replay. Thank you, Jay. Thank you for the acknowledgement. Alexander, my price max is $115,000 and don't want to buy a 1900s house. Yeah, I got that. But you know what? That house has been sitting there for 70, 80, 100 years. It'll probably be sitting there for another 70, 80, 100 years, and people will need a roof over their head. Somebody absolutely will move into it. Okay, but I understand where you're coming from. But just in this kind of a market where the market is such a seller's market, we might not be able to be so choosy. We might just have to get something so we can actually start, right? George Gammon, thank you, Lewis. Yes, that's his name. I love his podcast. I listen to it all the time. Alexander, don't want to be stuck in ghetto area. I understand. I had to call the cops 20 times, so I'm being careful. Yeah, you want to be safe, right? You would definitely want to be safe. But for most parts, I think the max for an FHA is right around between 275, 325 nationally. And that can get you out of the ghetto. That's not going to be in a dangerous place. You can have a nice, acceptable living in most parts of the country with that. Might not be your ideal dream home, but 3.5% down on a $300,000 property, it's only 10 grand. You can put that on a credit card. Shouldn't be any excuse. Okay. Let's see. Brandon, don't hesitate to call the banks and share your vision. They are working with investors to get into deals. Yeah, Brandon's a private REI ACE client of mine, and he's done really well for himself. And I believe you've walked away from your job now after a year or so working together. So congrats. And he's out there mixing it up. He's a really great resource. So if you want to befriend him, he'd be a great resource. And he's doing a lot of collaborations. If you want to come along for ride his coattails, he's looking for private money. He's got more deals than he's got money. Great way to go ahead and build something together. All right, y'all. So I think we're good. We did that pretty good. All right. I'm liking these live things. And thanks for waiting for me for a minute late. And, but I was putting that stuff together. So everything I gave to you was right there, right, brand new, fresh. Okay. Got 21 for the year, 3 more to go for the 2021 goal. Fantastic. Congrats, Brandon. You make me proud, bud. And by the way, if you'd like to join us next week for a little workshop on creative financing, you can go to creativefinancingmasterclass.com and spend the day with us. We're going to talk about how to put these deals together using very little to any of your money. We're going to talk about how to find these deals. We're going to talk how to protect these deals once you got them. And then we're going to be talking about some advanced strategies, something that I'm doing called velocity investing, where I'm maximizing my ROI while I'm actually decreasing my risk. I was going to say increasing my risk mitigation, but that's like a double negative or something like that. No, but getting more return, less risk. And then I've got some guests going to talk about the deal after the deal, something that very few people know about. So we're going to be talking about that. So again, if you'd like to join us, please do over at creativefinancingmasterclass.com. And I will see you there. But if I don't, then I will just see you the next time I see you here. Okay. Peace, God bless, and health and wealth and prosperity to you and your family. And I will, I'm going to call it a day, and I'll see you next time. Take care. Bye.